Welcome to It's No Secret, a podcast for those who want their money questions answered.
Join us as we talk to real Kiwis and share truths about our own financial lives, because the truth is, there is no secret to achieving financial freedom. Lovely listeners, welcome back to another episode of It's No Secret. I'm Kat, and today we're joined by Kernel founder and CE Dean Anderson. Hi Dean, welcome.
Good morning.
Today we'll be chatting about the OCR.
Yeah.
And a bit of a disclaimer, we are recording this episode on the 13th of Feb, so pre the scheduled RBNZ review of the OCR and announcement next week. But this is dropping into your ears on the day that the OCR is announced. So depending on what time you're listening.
Which version are we dropping?
Yes, so depending on the timing of when you're listening to this, the announcement that we're talking about has either happened or is shortly about to. But today we're really wanting to dive into three kind of key things to think about or tips when a significant OCR change happens. And I guess, why it's important, why not to panic, why it's potentially good for some people and why it's potentially a negative for others. Because depending on where you are in your circumstances, you're either probably looking forward to an OCR cut with excitement, or potentially you are looking at it with a bit of like, oh, now I'm going to have to rethink a strategy. So kind of, I guess, Dean, to set the scene, where are we at in terms of interest rates at the moment, and what are we suspecting or expecting will happen next week?
Yeah, so I think everybody is looking towards, currently still sitting at about a 50 basis point cut is the middle of the road where most of the market seems to be assuming that the OCR is going to drop. And, you know, in context, that's a large percentage change from where we are. There, 2 or 3 months ago, that was looking like it could be 75 when New Zealand economy wasn't looking so good. And therefore, the idea was that RBNZ is going to have to do a bigger cut to try and create some more economic stimulus by lowering people's cost to borrow, basically. Now, though, that sort of eased slightly, not so much the fact that New Zealand is in a much stronger position, but more from the fact that the US is in a stronger position and we don't want to be too out of sync with the US. And so there's even been chat about a 25 basis point cut, so 0.25% cut, but still looking like the favourable position is sort of a 50 basis point, 0.5% cut.
Yeah, nice. Great. So I guess with that and pretty much all-round commitment from everybody that there's likely to be a cut, like I think the idea of it holding or staying as is probably not on the table at all. Yep. Let's talk through, I guess, then how you would approach that. So tip number one that we have is, I think, whenever anything like this changes in the economy, is really going back to sticking to your timelines and your goals, like not necessarily reacting to something that has happened outside of our control. So Dean, who should be reacting?
So there are, as you touched on the opening, there are two sides of this equation: those that are borrowing money and those that are saving and investing their money. Yep. So the easier one to tackle maybe is the borrowers, those who have got a mortgage.
And they'll be excited. I'm excited.
They will be excited. I think there is something like 80% of mortgage issuance is coming off or up for renewal this year.
Westpac just sent me the automated emails this week being like, refix now. I'm like, no, thank you. I'm away a week and a half.
So there is a lot of gamesmanship with banks where they are trying to incentivize you into particular times. Like you've seen recently, there's been a lot of cuts towards 3-year rates. And they're just trying to balance their books and their liabilities and trying to get you into the best for their own position, right? But what we need to remember is that a whole bunch of people have gotten their mortgages that are maturing or are currently on floating. There's a lot more on floating than historically there normally is. It's not common for Kiwis to be floating. That's because I think people have anticipated that rates coming down, which has been the case. Yep. I think the big thing that we're going to see out of this OCR announcement is similar to the US, is a likely lower expectation of future cuts. So borrowers out there who have been holding on thinking we're going to go back to a 2.5% rate, probably that is not the case. Yep. You look at the US now, inflation is higher. The Federal Reserve is basically saying they're not really expecting any more cuts. They're in a sort of a holding pattern now. And so expect to see a bit of that message with the announcement on the OCR today. So from a borrower's perspective, you are going to want to start looking and go, look, your mortgage rates aren't going to probably fall that much more. The cut is already almost baked in to maybe not the full degree, but a reasonable amount. So
And it might be a case of just assessing between the banks, right? Like perhaps your bigger leverage is to, if you are rolling off a fixed rate, actually potentially look at your loyalty factor and be like, to your point, different banks will have different positions based on their customer segments. Yeah. And so it might just, needing to be shopping around.
So a borrower is quite easy, right? Like you're starting to see probably the base level now about where interest rates are going to sit.
Yep.
For a lot of people out there who have borrowed in the last couple of years, and most people would have had a term that's been under 5 years, for a large percentage of people, you are going to be going into lower rates. You've probably been on a 6 or 7, so now you're into a 4.5. That's great. That's going to save you a lot each week.
Yep.
Good for New Zealand economy because all of a sudden we're going to have a few $1 billion more because people are saving a couple of $100 a week.
Yes.
So kind of step back and go, okay, I'm borrowing. I'm not expecting it to fall significantly further. Let's start to lock in some mortgage rates because we're going to create some certainty for our budget for a household.
Yep.
We're going to take a little bit of the pressure off. We're going to know what our budget's like, and we're going to carry on with our lives and have a bit more flexibility rather than all of our money going to service the mortgage. So that's a good win for borrowers.
Yep.
You do want to keep an eye on some of those longer rates as well. There are probably some good opportunities. Speak to a mortgage broker. They can help, but you can basically now start building a budget plan because you kind of know where the status quo is. And you could effectively lock that in. Like if you wanted 5 years of certainty, fine. Even if it drops slightly more, you've got 5 years of certainty. Savers and investors.
Yeah.
There is something like a couple of $100 billion, I should know the stat off the top of my head, sitting in term deposits in New Zealand. That is a massive amount of money. Kiwis love term deposits.
They do.
Depending on the term deposit, some of them pay out regularly, some of them only pay interest at the end. But with a term deposit, what you're doing is lending some money to a bank for a set interest rate for a set period of time. And typically a lot of Kiwis are putting it in for 6, 9, 12 months, maybe 18 months. We don't have a lot that goes into the longer, like 4 or 5 year term deposits. Often it tends to be sort of 12, 24 months.
Yeah. And at the moment, the 1 year rates with the main banks are around like 4.3, 0.55%, depending on who you're with.
So pretty similar to the OCR,
would we expecting it to, then essentially, you would expect to see a drop of around the same percentage
points. A lot of
points.
the banks, the term deposits depends on what they're trying to do with the funding. You typically see a pretty quick reaction in any savings accounts. But you've got to remember, actually, most people, your day-to-day bank account probably doesn't pay you anything anyway. The banks don't just generously give you more money. You have to open up particular savings accounts, and often many of them require you to not make a withdrawal, make a deposit to actually even get any interest. But you'll see some change to savings rates, and Kernel will. Kernel has an on-call savings rate, which is a standard on-call bank savings account. It's 3.8%. And that's right. And that will adjust down with OCR, but it's actually one of the best savings rates in the market for online bank accounts. So you will expect to see that come down. Term deposits will also start to drift down. So savers really need to think about, okay, if you do have a savings need, either you're conservative or you're wanting income in retirement or you're planning for a home. Or we've seen some cases where people have sold their home recently and are sitting on it for 12 months.
I've got a great scenario on that because we had a listener from the pod chat to me last week about the fact that they're receiving a lump sum of money. They're getting $800,000 from a family estate sale, right, in a property. And they are, I'd say, more in the like conservative category of people because they are in their 60s. They're still working, but actually, no, they're not working. They're retired. So comfortably living off like superannuation and their KiwiSaver. But this is a significant amount of money for them in terms of like, shoring up their retirement. And the idea was that they were just going to park this amount of money in a term deposit and then use the income to supplement their living expenses and expenditure. And one key expenditure was, as part of this estate sale, they had been living with a family member who passed away, and so they wanted to go on rent. They didn't want to lock into like buying another house because they kind of, don't know if you want to stay there forever or if you might move to a retirement village, that kind of thing. So they thought like renting was a good flexibility. And when I looked at the numbers this morning, I was like, it is a bit of a catch-22, right? Because, on say 4.3% on 800,000, you're looking at about 34,000 in interest each year, but that's pre-tax. And then you've got to take, your 6,000 odd off in tax, which nets you about 28,000. And then actually when you divide 28,000 by 52, you've only got $540 a week to work with. And if that is your sole source of income to fund a core expense like rent or, your core living expenses, that is somewhat doable, I would say, with, where interest rates are currently are. But when you all of a sudden start to look at term deposits that are perhaps paying something in the threes, that all of a sudden comes under stress. And so how do you balance that decision or need, I guess, between like someone that's perhaps naturally a bit conservative and wants some income, but is also facing the reality that interest rates getting lower on something like a TD or a high interest savings account is not going to be the thing that serves them?
Let's park for another day the whole should you be saving or investing money, right? Because with 800,000 in retirement, there's probably some strong arguments that some of that money, not all of it, should be invested into growth assets like shares to grow for the longer term to sustain your future income needs. Because as you've highlighted, you're probably going to be eating into more of it than what actually it's generating an income.
Because you need to use some of the capital, and so then you're reducing that amount over time.
Over time, you slowly dwindle down the pot, and that's what a lot of people get wrong in retirement is that they take all their KiwiSaver, put it in cash, and then they start eating into it, and then they run out of money later in retirement. But that's another day. So let's focus on what do you do with actual savings needs and what are the options. So term deposits that you highlighted is the go-to for a lot of people. It's familiar. It's known.
It's easy.
It is easy. The trouble is obviously rates are going to come down. The downside of term deposits are a couple of fold. One is you're locked in, so you don't have flexibility. So if there was a change in circumstances or you wanted to tap into a little bit, it's not that easy. You may have to break it, which could have a change in terms. It may change your interest rates. A lot of term deposits don't pay out until maturity. So if you wanted to lock in a higher rate, you may be locking in for 12 to 24 months, but you may not be getting actually regular cash flow off that.
Not serving the cash flow need.
You then need to consider, are you on a higher tax rate? So if you're a 33% investor, or 30 or a 39% investor, then tax is going to eat into a lot of that interest income.
More. Well, this example was assuming a 17.5, which is probably pretty
that's okay.
Generous.
So
but
you would get that.
If you had some income like this and, some income from other investments and then say NZ Super, it's pretty likely you're tipping over the 30% rate.
Yeah, so that's when you want to start looking at pie structured products, which is where tax will be capped at 28%. You can get term deposit pies these days. And thankfully, what has changed compared to a few years ago is actually what banks used to do. They're not as bad as this now. But you would see, say, a standard term deposit advertised at 4.5%, but for the same term, the pie term deposit was actually at, say, 4 or 3.5%.
Right.
So that when you adjusted for tax, actually you end up with the same result. So they're a bit sneaky that they weren't trying to, let you get ahead and optimize. They were just going to take that little difference themselves. But that has leveled out. So term deposit pies and non-pies, they seem to be similar rates now in most cases. So you definitely want to consider tax depending on the product you're picking. But stepping back, okay, what's the role of term deposits and what are the alternatives? So obviously standard on-call savings accounts typically won't get you as higher interest rate. But if I come back to the opening, we're not expecting the same sort of cuts going ahead as we were previously. So 18 months ago, 24 months ago, term deposits were quite a logical choice because somebody's going, okay, I'm going to lock in now 5.5%, 6%, and we know that interest rates are starting to trend down because our economy's not doing well and there's clear forecasting and signaling that rates are going to come down. So locking into a term deposit back then was great because your savings accounts were going to be quickly falling in interest rates as the OCR dropped. But now we're getting towards the bottom. And so the reduction in rates going forward isn't going to be the same. So the benefit of locking in now is a lot less because your savings accounts are actually going to be pretty similar and they're going to give you more flexibility. So that's a good time now for investors to look around and go, well, what else could we consider? And things like cash funds. So Kernel launched a cash fund, which is a pie. Yes, it's slightly different. It's got a different risk profile. So it's not like a standard bank account. It holds savings accounts. It does hold term deposits. It holds also some very short-term bond instruments. But it has a yield that fluctuates pretty similar to like what you would expect. Think of it more like being on a floating mortgage. Like that rate will fluctuate slightly. But you have the benefit of flexibility to come in and out as you see. And so for an investor now, you will probably end up with a similar sort of return to a term deposit actually. But you're not locking yourself in.
Yep.
You can get a quarterly income.
Yes.
Or if you just wanted to sell down $100 a week because you wanted a regular income, you can do that without any restrictions or penalties. Yep. So I think now that interest rates are sort of starting to post this OCR look like they're going to plateau a bit, maybe there'll be one or two cuts down the line, the benefit of locking in at term deposits has sort of gone away.
Yep.
And so now it's going to be a big question when $200 billion starts rolling off and those mortgages, those term deposits start maturing.
Yes.
Where do you put that money?
Yep.
And that's where investors do want to start looking maybe outside of what they've done historically.
Yeah. Yeah. I think as well, like, mentioning that something like a cash fund or a fixed income fund is a reasonable place for people to consider starting can be a really good thing, because if you're going to a provider that has one of those, they probably have other types of funds for other risk profiles, right? And what we often see in this scenario is that people make a knee-jerk reaction to the fact that they're not getting the income or the growth on the term deposit that they previously were, and they kind of jump into something that on face value looks like it's going to have a really great return, not thinking through the likelihood or a definite eventuality that if that's an equity fund, it's going to go up and down. And then they start to feel naturally a bit uneasy by that. But if you say, are going from a bank environment and a term deposit where there's very, very high certainty and low rates, and you're perhaps using something like a cash fund as a transition step to get a slightly better rate, but also with a fairly decent level of certainty and low level of risk, you can then do that. And while testing out your comfort as to, to your point with that $800,000, probably not all of that should be in a cash fund if that's something that needs to last from 65 to 85, because again, you've got a really big time horizon. But having a middle step, so it's not necessarily just term deposit straight into an equity fund if you've never had any experience in between, is potentially a good idea.
Cash funds, fixed income funds, again, they haven't been that common in New Zealand, right? Even cash funds, simple cash funds like what we've run at Kernel, have not been the norm here or the go-to, because I think people have been so focused on term deposits and other investments. But if you look at US and other markets, these are really common approaches for how people manage their money. And so, again, you can get flexibility, you get tax structuring, but you can still get a good yield. You just need to understand how that differs from a bank and forming comfort there. But risk and understanding risk is really key. And the major public disclaimer and warning I want to put out here now, the biggest thing that I would be worried about right now that I think we should be conscious of and sharing and communicating is, as these term deposits mature, people will start to become very attracted to reading in the newspaper the 10% return offered by these wholesale funds. Need to be really clear, what is a wholesale fund that often have words like guaranteed, these personal guarantees, by the way, versus what is a more regulated, structured fund like a cash fund through Kernel. So we know that a lot of people get attracted to these things. These are typically mortgage funds or other sort of syndicate funds, and they typically have a 7.5% or 10% set yield, pays out quarterly. Please be really aware as to what you're getting into, because wholesale funds effectively have none of the protections or checks and balances like a fund that has a product disclosure statement does have. So if you think about Kernel, all of our funds are retail structured. They have a product disclosure statement. It's like your KiwiSaver. So what does that mean? It means that the assets are ring-fenced in the fund. There's a separate custodian. There is an independent supervisor. It's highly regulated by the Financial Markets Authority. So our standard cash fund has the same checks and balances as the biggest bank's KiwiSaver fund. With a wholesale fund, you don't have to have any of that. You don't have to have those independent supervisors. You don't have any of those protections. So people see the word wholesale and think that it means it's for people with big balances or it's a more sophisticated product. Really, that's not the case at all. It's a potentially much higher risk. And we've seen that. We've seen previously some really good examples where people have gone in chasing a better yield. There were some good articles in the Herald maybe 18 months ago of somebody that put it into a property syndicate fund that was paying monthly. All of a sudden, that fund was no longer able to pay out its distributions. That couple, who I think had about 750,000 invested, they were probably retirees, I think, as well. Thankfully, they'd taken a couple of $100,000 out, but not only did the funds stop paying income, they were not able to get their money out. They were not able to withdraw.
Yep.
There was a freeze on it. And so people need to be really, really cautious that as term deposit rates come down,
Yep.
to understand the risk you're taking on when you get tempted by something that advertising what seems to be a much higher interest rate.
Yes.
That is not guaranteed. And that does not give you the protections that you would get in a standard retail structured fund. So just big, massive disclaimer there. Really understand the risk and understand what you're taking on.
Yeah. Totally agree with that. I mean, we would love to see some money coming out of bank accounts because we do obviously strongly feel that, there's a lot of New Zealanders that are probably sleeping on the amount of money that they do have sitting in just standard everyday savings accounts or term deposits and should be looking at other options. But yeah, exactly to your point, making sure that you know what are the regulated options, what are the options that, you have full disclosures and information on, what are the options with companies.
Transparent, that are regulated.
Exactly, really clear so that you can have accessibility and transparency and understanding of where your money's going. Because if you've been familiar with a bank, totally appreciate that then moving to an investment company is something that you also want to do a bit of DD and research on too.
And quiz us, ask us, and we're more than happy to share that anybody should be, right?
Yeah.
But yes, the big call out is those wholesale funds. And I've seen it personally.
Yeah.
Even over the last 2 or 3 months, I've had these conversations where family, friends, and others have said, "Oh, we've got a couple of $1 million in term deposits maturing in January, and the rates seem a lot lower. Have you heard about XYZ company? It's been advertising in all these papers, and they're paying 10%. That seems really a good option." And the concerning pieces, be it listeners or parents of listeners, particularly like a lot of older people who have been historically only comfortable with these set interest rate, tend to go and put all of their wealth into these things. So yes, that's the thing I'm probably most concerned about with the falling interest rates, is that, as we covered, there is $200 billion in term deposits. There's about $70 or $80 billion sitting in savings accounts. As rates fall, people start to stretch the limits of their risk.
In ways that are not great.
Yeah.
Not great in the long term. No, absolutely. Cool. So interest rate OCR day today, as you're listening. Hopefully some good news for those of us that do have mortgages, and for those that are in the savings or kind of TD camp at the moment, looking for some other options or just thinking about it. I think also in these types of changes, like, you don't need to make a decision on the day or the next day with any financial change in your life. We always talk about making sure you take a bit of time. Ultimately, if let's say you do have a term deposit that literally has just matured and that money sits there for a week whilst you decide what to do with it and doesn't earn any interest, that's not going to materially impact you, whereas potentially making a poor decision or a rushed decision will. Making sure you take a bit of time and really think about what you need the money for, when you want to access it, flexibility, risk, and your overall comfort level. So on that note, big thanks to Kernel for enabling us to do what we do. Don't forget to hit like and subscribe wherever you're tuning in, whether that's video on YouTube or listening on Spotify and Apple Podcasts. If you have any questions, feel free to get in touch, as always, at It's No Secret NZ on Instagram. Send us episode requests, feedback, and more. Thanks for listening. See you next week.